The close continues. Hello again. I'm Michael Hainsworth. We're continuing to monitor the situation on Capitol Hill in Washington after what is believed to be a female shooter with a child in the backseat of her car rammed the gates at the White House and then proceeded to move down the street along First Avenue to where at Constitution there was an altercation, it believes, with the Capitol Police. An officer has been injured. We don't know in which way, other than that he was in his scout car at the time. We have reports of other additional injuries as well. In addition, the alleged shooter is believed to have been shot herself by state police or the Capitol Police themselves. We don't know the condition of the shooter or that of her child, other than Capitol Police believe that there was a child in the car. All of this happened during the regular trading session, and at about 1:30 Eastern Time is when the street started to learn of the news as it trickled out on various sources, including Twitter. Diana Avigdor is a portfolio manager and the head of trading at Barometer Capital. She joins us now to tell us what she was thinking when she first got wind of the news. Diana, good to have you with us.
Thank you very much.
What does this do for investor psychology?
You know, it doesn't change the economics, but what it does, the surprises that we've been getting in the market is what's made trading a little light, actually. It's been low volume all day. Europe volumes were down 30%. We've started the day on a slippery slope to begin with, as we are already watching the macroeconomics, the U.S. Government shutdown. And the markets were rallying on news that perhaps there was some development on the talks when we got wind of the shooting, and that took markets down slightly, but then they recovered.
And that seems to give us some indication that we know that because this is, or we believe that because this is an isolated incident, that basically it's back to business as usual and focusing more on that big macro theme?
I think that what's happened in our trading world is that there is a lot of external trading effect. So when you get a news like this, you have a lot of people trying to put on positions for a potentially short-term trade. And when that doesn't work out, when that doesn't have any institutional or real money follow through, then those shorts that are trying to do short-term trading, they just need to cover and things just settle down. I think the bigger problem is the macroeconomic government shutdown issue, and the biggest surprise, the thing that started our session of surprises was the no taper by Mr. Bernanke.
Tell me about that, particularly because we did have the Treasury Department come out with this, I'm hesitant to call it a Chicken Little claim, because they did say that the U.S. would fall into a recession greater than the Great Recession we saw of 2008, but it was couched with a series of ifs. If we don't manage to deal with this debt ceiling, if we default, are these genuine threats at this point?
You know, it depends on how long they're shut down. I think that there is a real economic threat if this goes on, say 1, 2, 3, 4 weeks. I can't see that happening. Of course, the longer it goes on, the bigger of a problem it becomes. But if we were to take the politics out and let's just go back to everything was fine, our expectations were well managed, Mr. Bernanke was a master at being communicative with everybody, so we knew what to expect, and then we had the no taper. That on its own was a bit of an issue because we questioned ourselves. Okay, we know that the economy is not growing very fast. We know it's just snail pace. But what did they see to not even discuss the taper, which was so known in the market, so expected? So we don't like surprises like that. I think that's the worst situation. It's not about slower growth or whatnot. It's just about management of expectations and at least knowing what you're expecting. So the surprises are never good. And today, the shutdown, I mean, did anybody expect the government to shut down 1 or 2 days? No, but the longer it goes on, the more of a problem it becomes.
What happened to the sentiment that I've been hearing on day one is that this will be a 3-day event, a 5-day event. By the end of the week, we'll have it all figured out. What's changed sentiment-wise? Because it doesn't seem like we've gotten any actual hard facts to back up either claims.
Absolutely. There was so many conversations. On Monday, we were heading towards the shutdown, and Tuesday was the shutdown, if I recall. On Monday, there were calculations and countings of how many shutdowns we've had and how long they've lasted on average. And on average, they lasted a couple of days, and so that kind of information was circulated and digested on trading desks back and forth. So I think that that's what sort of set the tone. I'm surprised at the lack of correlation between headlines and market moves. So Monday, for example, we were heading towards a shutdown and markets were weak. Tuesday, on the first day of the shutdown, market closed at highs. NASDAQ 100 made a new high, Russell made a new high, S&P 400 made a new high. So what was market doing making new highs when the government shut down? The next day, the polar opposite. I want to also mention the fact that for the first time in a long time, there were money flows that went out of equities and into bonds. And you and I last spoke, we talked about their respect for money flows. And there was conversation at the fact that at the end of the quarter, there was a large pension rebalance to be done, as equities have really outperformed fixed income by about 8%. So there was some rebalancing. But maybe some of that is also still in the market. If you look at the closes and the futures on Tuesday, Wednesday, and not today yet, I haven't seen it, but you saw very, very big volatility on the close. So there's got to be some of that money flow moving around as well.
Diana, great getting your take. Thank you for your time.
Thank you very much.
Diana Avigdor is a portfolio manager and head of trading at Barometer Capital.